Same stock, same trader, same setup, executed the same way, 2 days in a row. On Monday, every breakout fails. Price keeps getting dragged back to the middle. Fading the extremes works beautifully. On Tuesday, the exact same fade gets run over. Price picks a direction and just goes, and it never gives you the pullback. Most traders conclude they made a mistake on Tuesday. Usually they didn't. The market changed regimes underneath them, and the setup that fit Monday was simply the wrong tool for Tuesday. Here's what actually changes. Quick recap if you're jumping in here. Market makers take the other side of options trades. They don't want a directional bet, so they hedge with real shares. And because delta keeps changing as price moves, they have to keep re-hedging all day long. So far, we've mostly assumed that hedging chases price, buying as it rises, selling as it falls. That's true. Sometimes. The other half of the time, it does the exact opposite. And that's the difference between Monday and Tuesday. It comes down to one question. Are the dealers net owners of options or net sellers of them? Because their hedging runs in opposite directions depending on the answer. When they've sold options to the public, the industry calls them short gamma. When they own more options than they've sold, they're long gamma. Those two phrases sound like jargon, but the behavior behind them is simple and you can see it on a chart. Let's do each one. Start with dealers being short, they've sold options, and the public owns them. This is common when there's a lot of enthusiasm and people are buying calls, or a lot of fear and people are buying puts. Price rises. The options they sold now act like more shares, so they're underhedged, and they have to buy stock to catch up. That buying pushes price higher, which means they need to buy again. The same thing runs in reverse on the way down. Price falls. They have to sell. The selling pushes price lower, so they sell more. Hedging chases price. Every move gets amplified. This is the regime where trends run further than they should, breakouts actually work, and fading the move gets you steamrolled. That's Tuesday. Now flip it. Dealers own more options than they've sold. This shows up when institutions are systematically selling options, writing calls against stock they hold, for instance, and dealers end up on the buying side. Now, the arithmetic reverses. Price rises, and their hedge requires them to sell stock. That selling caps the rally. Price falls, and their hedge requires them to buy, which cushions the decline. Hedging leans against price instead of chasing it. Every move gets dampened. Rallies stall, dips get bought, and price keeps getting pulled back toward the middle. That's Monday. That's what people mean when they say a market is pinned. And this is the part worth sitting with. It's the identical mechanic in both cases. Nobody changed strategy. Nobody decided to manipulate anything. Dealers are doing the same neutral mechanical risk management either way. The only thing that changed is which side of the contracts they ended up holding. And that one difference flips the market from calm and range-bound to trending and violent, not because sentiment changed, because the hedging arithmetic changed sign. Now, that regime isn't fixed. It shifts as price moves because the mix of contracts around price is different at different levels. So there's typically a transition zone, a price area where the net positioning flips from one side to the other. Above it, hedging tends to dampen. Below it, hedging tends to amplify. You'll hear this called the gamma flip or the zero gamma level. Whatever the name, the useful part is what it implies. A market that's been calm all week can change character quickly once price crosses into the other zone, without any news at all. That's why volatility so often seems to arrive out of nowhere. It didn't. The stabilizing force just switched off. So, what do you actually do with this? 3 things, and none of them are predictions. First, expectations. Knowing the regime tells you whether to expect follow-through or reversion. Same chart pattern, very different odds of it running. Second, setup selection. Mean reversion trades and fades fit a dampened regime. Breakouts and momentum trades fit an amplified one. Traders who run one style all the time have great weeks and terrible weeks, and often can't explain why. This is frequently why. Third, sizing and stops. In an amplified regime, moves overshoot, so a stop that's normally comfortable gets clipped by noise. In a dampened one, targets that normally fill just never get there. You're not forecasting direction with any of this. You're adjusting how you engage. Now the honest part. And this one matters more than usual. Nobody outside those firms sees their actual books. Every estimate of which regime you're in is exactly that, an estimate built by inferring from observable positioning data. It's a good inference, and it's far better than guessing. But it's not a fact, and anyone presenting it as a precise number is overselling it. Second, it changes. Positioning gets built and unwound continuously, and around expiration it can reset dramatically. And third, it can be overwhelmed. Real news. A genuine shift in fundamentals, a determined institutional buyer, those move price regardless of where the hedging pressure sits. Structure is a strong current, not a wall. Treat it as context that shapes the odds, not a rule that governs the tape. So, to recap, when dealers have sold options, their hedging chases price, and moves get amplified. Trends run, breakouts work, fades get punished. When dealers own options, their hedging leans against price, and moves get dampened, ranges hold, rallies stall, dips get bought. Same mechanic, opposite sign, and it shifts as price crosses between zones. Monday and Tuesday weren't the same market. Knowing which one you're standing in is most of the edge. MobiTick estimates where that net positioning sits and plots it alongside the key levels on your chart, so the regime is something you check rather than something you find out the hard way. Next in the series, why those levels sometimes break clean through and what it usually means when they do.